Hey guys, I want to talk in this blog post about NOI, net operating income. If you're selling investment property, whether you're a first timer or a lifer, NOI is going to be one of the most important factors that you can offer to be able to value a property and show its investment potential. Net operating income is simple. It's gross income, the amount of rents and amount of money coming in off of that property, whether it's rents, quarters from the washer and dryer, pet fees, parking fees, all of the things that property makes in gross income minus operating expenses. Simple calculation. How much money am I making versus how much money am I spending to make it? And that will get you net operating income. Net operating income does not take into account debt service or taxes or anything that doesn't go into the direct management day-to-day operations of that building. So keep that in mind. If you add that stuff in, you'll get what's called cash flow, which is another important analysis that we'll talk about at a different time. You can use net operating income and market cap rates to be able to value a building based on how much money it makes. If you're representing a buyer, you can, within reason, judge how much money their money is going to make on an annual basis. And this is obviously important when you're talking to investors. Let's go over a couple tips for properly calculating net operating income, and we can actually work through a case study that is in the blog as well, so you can read along with me. One of the most important things in calculating net operating income is being thorough. You want to make sure you account for all of your operating costs correctly. Missing a management fee or any other types of fees that you pay out can lead to inflated NOI numbers and totally skew everything. Make sure you're checking the income properly. And also, don't miscategorize things. A one-time big maintenance expense, like putting a new roof on a building, that's not an operating cost. You're not going to include that in the expenses, even though it may fall into an expense category on a P&L. Loan payments, another thing that doesn't fall into it. That's not an operating expense. That is a personal debt that is being paid to carry the note. So you don't want to include that in there either. Let's go over an easy example that you can find on my blog post. If a property earns $120,000 annually from rent and takes an additional $10,000 in parking fees, that property as a whole makes $130,000. Remember, we want to add all those income streams from that property. And then you want to subtract from that any expenses. In the blog post, it goes over property management fees, repairs and maintenance, utilities, property taxes, insurance. Remember, don't include mortgage payments, depreciation, capital expenditures, and that new roof they just put on. Those things don't get put in there. So just make sure you're keeping the things that are monthly operating expenses. Let's say the property incurs $40,000 in annual operating expenses. The NOI will be your income of $130,000 minus your expenses of $40,000, which gives you $90,000 net operating income for you. Blog post goes over all sorts of good calculations and easy calculations you can make without being a master. But analyzing profitability, making important decisions based on deferred maintenance, taking vacancy rate into account, these are all things that you need to know about. And they're not necessarily hard. It may seem daunting if it's your first time selling a multifamily. Take your time, read the blog post below, and if you have any questions, don't hesitate to reach out. I'm happy to help explain or even help you calculate some of these things to make sure your transaction goes smoothly.